You had Yellen go before the congressional hearing on the economy and what they're doing, and of course she was able to drop hints about negative interest rates.
Attention hard asset investors. If you want to maximize your gold and silver holdings, consider owning businesses that own a massive amount of the metal, who will benefit the most as the world witnesses the mother of all gold rallies. With nearly 10 million ounces of gold resources through acquisition, this 50-cent stock has received a $2.65 price target from Cantor Fitzgerald. Learn more at crushthestreet.com/gold2016.
Hello, everyone, and welcome into CrushTheStreet.com. I am Kenneth Amaduri, and we got a new guest today, and he's got a multi-decade-long history working in the markets. His name is Lee Goss, a 1974 graduate of Illinois State University who began his career working for the agricultural giant Cargill. And after 2 years with Cargill, Lee accepted a position as a grain merchandiser commodity broker. And from 1974 to 1983, Lee traded cash commodities. And in 1994, Lee co-founded International Futures Group, Inc. And today, International Futures Group services clients all around the world. So, Lee, thanks so much for coming on the show today. I got a lot of questions for you. The markets are crazy volatile, so thanks for coming on.
Well, Ken, thanks for having me. It's quite an honor to be on your show, and I appreciate this opportunity and look forward to seeing if I can answer some questions.
Absolutely. Lee, you're a first-time guest on the show, so I'd like to start off by kind of getting your overall assessment on the current 2016 economy.
Well, I'm kind of different, I guess, than the majority of people. I think much like Warren Buffett said yesterday or the day before, that he thinks, and I agree with him, that the narrative on the economy coming out of Washington, D.C. and the politicians is too negative, that the economy is not as bad as they would have you believe, that it is recovering at a better rate than what perhaps they're recognizing. And that, if you just take a look, for instance, at the change in the price of gasoline around the country and the money that the added money that it is putting in the pocket of American citizens, I think that we're doing better than anticipated, or better than being reported, or better than they're telling us we are. I agree with Warren Buffett on that totally.
Okay, well, so, central banks around the world are acting desperately. We saw some news from China that they're lowering the reserve requirements from their banks, which is an effort to stimulate the economy. And the reaction within the stock market has been pretty dramatic after the 25 basis point rate hike that we saw in December going into January. January was the worst start for markets on record. And so, what are your thoughts on the stock market and what we've been seeing and, the central bank intervention that has been going on around the world now for some time? And, where is this all headed?
Well, that's an interesting question. It kind of brings to mind my favorite phrase over the last 3 or 4 years, and that's consequences associated with a lot of the decisions that these federal banks have made. If we go back, if you will, to January, you mentioned January being one of the worst on record. If you go back to January, what you had in actually going back to December is you had the Fed raised the interest rate by 0.25%. That 0.25% raise, for some reason, just seemed to scare the bejeebers out of the traders of the world. And one of the impact of that 0.25% raise was a continued escalation or continued pressure on the stock market. Now, shortly thereafter, I think it's about the middle of January, what you had the president of the New York Fed in an interview basically say that this impact of the 0.25% raise had so negatively impacted the stock market and had so positively impacted the value of the dollar, pushing the dollar to values that were detrimental to the economy, that the Fed might have to reconsider what they're doing at their March meeting. And all of a sudden, the market just the dollar just collapsed, and the stock market found a more solid footing. Now, about a week later, or 3 or 4 days later, you had Yellen go before the congressional hearing on the economy and what they're doing, and of course she was able to drop hints about negative interest rates. And then when asked directly about negative interest rates, she did confirm that while they had not decided to use negative interest rates, the Fed had indeed discussed negative interest rates, and that just kind of also added to the momentum of underpinning the stock market and a weaker dollar. Now, if anybody out there believes that these two comments were not contrived to work together to do exactly what they did, which was to underpin the stock market, or at least keep it from going a lot lower, I got some beachfront property in Colorado you can take a look at. They came out with their statements. They sent the message. The traders of the world acknowledge having received them, and the stock market consequently has found more solid footing. Is it in an uptrend? Is it the stock market bullish? No, it isn't. But it is not in the rapid decline that we saw in January. So then you turn around and you take a look at the dollar, which at one point during its downward move during all these comments, the dollar at one point was down over 2 complete points, is now fairly close to having rallied back to where it was when this whole stuff started. And so, what you have is you got this, you have a version of our federal bank, the Fed, coming out, and just by virtue of comments and suggestions, I don't want to say manipulating the market. I would rather say just basically helping direct the market in the direction in which they would like to see it go.
So what does it say, though, when they try to raise interest rates and markets panic? I mean, how long can they have this low interest rate or even negative interest rate policy go on before something else gives? I mean, the market seems to just be addicted to this easy money, low interest rate environment. So how long can this go on before they do have to raise interest rates and kind of pay the piper here?
Well, I think that quoting, or not quoting, but citing one of my favorites, which is Jimmy Rogers. He came out not too long ago and said the problem with the federal banks around the world is that they're being ruled by academians and bureaucrats, and they don't really have a true sense of what's going on in the market, and what they're doing is more harmful than beneficial. And so when will it all come to pass? One of the things Jimmy said in that interview was that they're trying to determine the strength of the economy by the value of the stock market, and that stock markets are made, like all markets, to go up and to go down, and they're artificially underpinning the stock market to give us the impression that the economy is doing okay, and it's the wrong vehicle. And you say, when will it come to an end? I don't know precisely when it'll come to an end. Obviously, if I did, I would probably be in the Bahamas instead of Chicago. But one of the things that we do know is that eventually markets exact a toll. and that a toll will come, and that we will see the stock market retract to a point where people will want to be a buyer without the benefit of an artificial stimulus. Where is that? I don't know. I personally believe that the economy is doing better than what we're being led to believe, and I think that they're using the wrong tool to measure it, which is the stock market. I think if you take a look at some other indicators that are out there, I think we're at a point in time coming off of the 2008 disaster where we're about ready to turn the corner with the degree of energy. This year should mark, I believe, the last year in which shadow inventory of foreclosed houses will hit the market. And once we kind of get through that, I think we're going to be in very, very good shape.
Well, there's no question that the stock market has become something the government and the economy has been addicted to going up. And, I actually don't have the facts right in front of me, but I know that every move down the stock market does. I mean, the government loses a lot more money in taxes than it did, let's say, in the 1920s when we had the Great Depression. I mean, the way it's set up now for each point or whatever it is that the stock market goes down, there's a great deal of loss that happens in terms of taxes. And so I do know that they are very dependent on a rising stock market, and we've seen them go to great extents to support it. And even today, we're doing this interview on Super Tuesday and just watching, Trump take the lead for the Republicans and Hillary in the lead for Democrats. I mean, we know that Janet Yellen is a Democrat, and I'm almost wondering the extent that the Fed will go to stabilize these markets for the sake of Democrat credibility going up until the election here.
Well, I would assume that the chances of that happening are very, very good. It is not uncommon for the Federal Reserve to take or to issue policy that is beneficial to the incumbent coming into, or the party coming into an election. The ones that didn't benefit from it, in my memory, were George Bush #1, when Greenspan kind of took an opposite approach to it, even after Bush #1 reappointed him. And Bush #1 even made a statement to the extent that he was so surprised at what Greenspan did that he was shocked that he would do it going into an election. And then, of course, the other one would have been McCain when he ran. And, of course, at that point in time, there was nothing the Fed could do to salvage that. It was such a mess. But, are they going to do it? Sure, they're going to do it. It's common for them to do it. I think they will do it. The problem, I think, that the Republicans have is that depending upon, if Donald Trump is going to be your candidate of the Republican Party, or if Cruz is the candidate of the Republican Party, I don't think the Fed's going to have to do anything to boost the economy. I think that the Republican Party winning with either one of those heading the ticket is slim to none. The one candidate, this is just my opinion. I've read more about it today in some of the publications. The governor of Ohio, I think he pronounces it Kasich, he could be a real problem for the Democrats. He's certainly hanging in there, and there's a lot of talk that he could be the candidate, especially if nobody comes into the convention with a majority. So, who knows? I do expect it to happen. It's something that has been pretty consistent historically. I just, I don't know. I guess I'm too old I guess I'm too jaded, but push comes to shove. I just don't see it having a great deal of meaning one way or the other. I think people recognize that it's manipulation for the benefit of a party or some, a candidate.
Lee, let's talk about precious metals, and what are your thoughts? I mean, I think we can agree at least these markets are somewhat volatile. What are your thoughts for precious metals? We've seen an uptick, especially in gold. And where has this uptick been derived from? Somewhat of a safe haven aspect, or just plain old fundamentals?
Well, I think it's been a combination, actually. There is a safe haven part to it. When you're talking about the Eurobank talking about negative interest rates, and Japan at negative interest rates, and you're talking about the Fed having discussed negative interest rates, these are things that will cause people to seek out a different avenue, medium for their investment. When you see the stock market being under pressure and having difficulty maintaining a serious rallies, where's the money going to go to? So I think, yes, there is a degree of safe haven involved in the gold market right now. I think the other part of it is I think we have to take a look at value. I think that when gold we started to approach $1,000 an ounce, I think that there were people around the world that just looked at gold as a decent buy just based upon value of $1,000 an ounce. Keeping in mind, it wasn't that long ago gold was approaching $2,000 an ounce, and you had some of the smartest guys in the room calling for gold to go as high as $3,000, and all of a sudden it's at $1,000 an ounce or near $1,000 an ounce. I think value had a lot to do with it, and gold is going to, silver being a poor man's gold is basically going to be following the same path. I think when you got silver approaching $10 and $11 an ounce, it was viewed as good value, and people seeking both investments and both investments and safety, looked at silver as an alternative. So I think it's a combination of the two that's underpinning or gives us this rally in the gold and silver markets.
So, Lee, you mentioned the dollar in our previous discussion a few minutes ago, and you were talking about how Fed policy is now weakening the dollar by them discussing negative interest rates and kind of not raising interest rates going forward, or just discussions about that. What are your thoughts on what we will see as far as dollar strength, dollar weakness against other currencies here in 2016?
Well, we'll probably see a lot of what we have, seen here in the past 6 months or a year. I think that a lot of the policy decisions that the Fed banks are making or coming up with are having are basically they're making those policies or making those decisions with hoping for the direct impact of cheapening their currencies to the world of export. So I think that what you're going to see is, no matter what the currency is, as it gets to levels that the respective Fed governments believe are hurting their exports, I think you'll see policies or statements or programs or measures being introduced to drive those currencies, whichever they may be, to lower levels to maintain their export market. I mean, this is my opinion and nothing more than my opinion, but what we have done, unintended consequences, what we have done with the quote-unquote free-floating currencies and the economic situation that the world has found itself in since 2008 is we have found that the various institutions, federal institutions around the world, are not necessarily real happy about or real crazy about absolutely free-floating currencies, that they're going to take measures to either move them lower or move them higher, depending on what the case may be. But mainly move them lower from higher levels to keep the exports from happening. If you take a look, if you remember not too long ago, where the Swiss Federal Bank came out, the Bank of Switzerland came out and said it was going to, basically peg the value of the Swiss to keep things stable inside the nation. And then on one day, months later, came out and said, well, they're going to quit doing that. And we saw within a millisecond, tens of millions, if not hundreds of millions of dollars change hand as an unprecedented move in the Swiss franc took place. So what do I think is going to happen? I think the Fed banks, whether it's the Bank of Japan, Bank of China, the Fed, the Euro Bank, the Bank of Switzerland, they're going to continue to manipulate or maneuver their policies to keep their currencies at levels where they think they need to be to stimulate or at least protect their export markets.
Lee, so in these volatile markets here, uncertain markets, what is your investment philosophy, and how do you personally advantage the volatility and uncertainty in these markets? Well,
that's a good question. I think that, if a person's looking at, a more traditional stock bond type of investment strategy, you're better off just looking long term and not taking to heart much of the short term machinations of the market. It'll drive you crazy. I think if a person's going to be taking a look at trading commodities, which is a much shorter term type of instrument, what one needs to basically concern themselves with and basically ask a question every day is what might happen today, what unexpected event could happen today in terms of an announcement from any of the Fed banks that could impact what I'm doing. And once having done that, if they decide to trade the markets, risk management is of absolute importance, just so that you're not ending up standing in front of a very short-term runaway rail car. Keep in mind what's happened in our markets many times, in my opinion, when these Fed banks, these federal bankers from around the world come out with their statements, with their policies, is that the market will react in a very violent manner, very volatile and violent manner. And then when the market has an opportunity to digest what has happened, a day or two or three later, you will see, in my opinion, will continue to see the market recover from that violent move and go back to, at, above, or near levels from which they started to begin with.
So do you think that we're going to be seeing new highs for the stock market here in 2016? Is that a reasonable assertion?
I don't think so. I don't think we have to have a bad 2016, but I just don't believe that. I just don't get the feeling that we're going to see new highs. Can we rally from here? Yeah, I think we can rally and probably will rally from here to some extent. Will we go back into a long-term uptrend in 2016? Maybe in the second half of the year we'll do that. Do I think we'll make new highs in the stock market? No, I don't. I just don't think there's the energy out there to get that done. I think there's too much uncertainty in the marketplace. And when the market has uncertainty, especially when you're taking a look at an equity market, the answer to that uncertainty isn't to buy more, but the answer to that uncertainty is usually to buy less or not buy at all or get out. So,
I mean, and the markets are very uncertain, and that's one thing that I've learned. I mean, I don't think anyone was expecting oil to go from $100 a barrel down to $30 a barrel and below. Mm-hmm. And it happened. It happened. And so, I hear what you're saying. It's kind of hard to predict. But at the same time, we've been so accustomed to the market kind of having a correction and then going up, that we kind of forgot what it's like to see it go down, lower, and then go really into a bear market here. And I think that if it does happen, will become a self-fulfilling prophecy, because, just like oil did, I mean, I really think the situation, I mean, the reaction to what we saw in 2008 with excessive money printing and QE and ultra low interest rates, I mean, there's going to be a release of that energy in the near future. And it's hard to say what will exactly happen, but I do believe that there will be an impact on our markets one day or another. So, Lee, I wanted to give you an opportunity here to just share some final thoughts before we said goodbye. Obviously, let everyone know about what you guys do and offer at International Futures Group, and just some final thoughts.
Well, International Futures Group is a retail commodity futures trading company. We're located in Chicago. We have a number of brokers, all of them very experienced, with probably specialty would be a good word. We all have kind of our specialty. What we try to do is basically impart good, solid, objective information, and service those accounts, the commodity trading accounts, at a competitive cost to the account, while providing superior service, in our opinion. And we've been around, I've been trading commodities now since 75, and my partner Tom has been trading commodities for even longer than that, and Steve slightly shorter than that. And so, we've got about 100 years plus of total commodity trading experience among the three of us. And, our brokers that we have working for us here, have similar type of experience. So, we just, we're not much of a... we don't high-pressure people. You ask a question, we'll give you the answer that as we see it, best of our opinion, and try to service the people in a fair manner.
Lee Goss, everyone, of International Futures Group. Lee, thanks so much for coming on the show with me and sharing your thoughts on the markets.
Kenneth, I appreciate this opportunity, and while I sit here in cold, frigid, icy rain Chicago, I'm very envious of your 79-degree California temperature.
Yes, sir. Thanks so much for coming on the show, and we'll talk soon. Thanks.
Have a great one. Bye-bye.